All right, good evening, folks. Back in the room again. Happy December. Hope you're enjoying the cold weather and the changing seasons. Um, Thanks for coming out tonight. I feel like this comes around pretty often, first Wednesday evening of the month, once again, but I'm always inspired just getting around a room full of people like this. It's a lot of work, sometimes putting these meetings together, and sometimes it can feel like a little bit of just a little bit of weight and a little bit of I don't know, stress is probably not the right word, but a little bit of weight that comes with doing it. But every time getting into a room like this, seeing you guys and remembering how I have been impacted by attending meetings like this always just makes it very worthwhile. And then having speakers that are willing to come and, in this case, travel 2.5 hours to get here. Yeah, we just appreciate that a lot. So anyway, for those of you that don't know me, my name is Jake Byler, local investor. Went into real estate full time about 15 years ago, I think, and I've attended a lot of meetings like this, and had the opportunity to be a part of this group back when it started, and host the group for the last number of years. And I just value the time of getting together around education, inspiration, and connection in a group. So thanks for coming out. I'm not going to take a lot of time tonight. I'm going to introduce our speaker here just shortly, but Matt Byler has been here before, and he's got a bunch of fun stuff to share tonight, so I'm not going to be up here very long at all. But just a quick note of our sponsors for this year. As you know, this meeting is free, and our expenses are paid for by sponsors, and our 2025 sponsors are Jeff Moeller. Jeff does some private lending. Joe Liofsky, Compass Property Management. Those guys are both in the room. We're both a part of this meeting back when it started. We have Sammy Stolzfuss from Mill Run Storage, Sam Glick, Red Box Dumpsters, Chet Lapp, Providence Real Estate Settlement Services, and Ben Yoesh, the local realtor. So those are the guys that are paying for our room rentals and the miscellaneous expenses that we have with the meetings. So anyway, we're going to dive right into, I'm going to give it my best attempt at giving Matt a proper introduction. This is always the part that I'm like, I don't know how to do this, but most of you guys know Matt Byler. How many of you guys have heard Matt speak before? Probably well over half of you. How many of you listen to his phone podcast that he does weekly? It's a pretty good amount of you. Get a couple new people we could spread the word to there, Matt, if we want. But Matt does a weekly phone podcast, I guess is what you call it. It's been doing that for a couple years. I tune into it almost every Monday when I go out for my run or something. It's just fun to listen to. But Matt has a lot of experience with investing. He approaches it probably a little bit differently than I do. I went into investing full time, like I said, about 15 years ago. Flipping properties, rental properties, and so forth, short-term rentals more recently. I think he would describe himself more as a business owner that uses investing to store capital or to protect capital maybe. But Matt has just had a lot of different experiences and exposure in different asset classes, different investment types, and he talks about it a lot on his podcast, and he's just gotten really good at sharing his perspectives and insights around that. If you've been in this room any number of times, you very well know that you get many, many different perspectives, different pieces of advice from different people. It's just the reality of being in this business. There's so many different perspectives on investing, on business, on wealth, and all of that. And what's also interesting is Matt's advice now would be different than it was 10 years ago. Mine would be different, at least somewhat different than it was 10 years ago. And it'll probably also be different in 10 years from now, which is kind of interesting. But it's not about getting it all right or having the right predictions or methods or whatever. But it's a lot about learning from each other's stories and experiences. And then Matt's going to give you a bunch of content, and then you can go do with it whatever you want, right? But like I said, Matt's just a fun guy to listen to. I'm sure there'll be a lot of stories and hopefully some interaction if you guys have questions. I don't know if Matt wants to save questions until the end or if he wants them throughout. Um, but yeah, it should be a lot of fun. So without taking up more time, please help me welcome Matt Byler. There you go.
Thanks, Jake. Yeah, make sure you have a comfortable chair. You'll probably need to take a nap before this is all over.
Sure that clicker still works.
Yeah, something's... There we go. Okay. Hey, good to see you guys. So, my goal is to give you at least one thing that you can leave with and do better with in the next year. I'm going to say a lot of words. You'll forget most of them, but if you can at least remember one thing, it'll be worthwhile. So winning is a lot of fun, right? It's just a blast. And but for me personally, I haven't always won. I have also had some bad mistakes. By the way, that was not me. It's just an example. But in investing, I've had some good crashes. Enough so it's been discouraging. How many of you remember hearing about Mahogany Bay Village? Anyone ever heard of it? Yeah, me too. Wish I hadn't, but I did. What did I learn? I thought, what could possibly go wrong? And I'm telling you, I found out what possibly could go wrong. How about the heyday of syndications? It was all about teamwork, right? And that's very true. Teamwork is awesome. What could possibly go wrong? Well, I learned that when there's teams that are motivated for the wrong reasons, things can go wrong. And by the way, I'm not here, I'm not trying to knock anyone. I want that to be really clear. It's just to help learn what we're looking for sometimes becomes more clear when we know what to not look for. How about ATMs? Anyone ever heard of investing in ATMs? Yeah. So did I, and I wish I hadn't. But lucky me, I didn't lose as much money as I should have, or as I probably would have, because I thought it was too boring. Not because I was so smart and thought it was fraudulent. I thought it was just such a... There's two reasons, really. One, I thought it was a boring business. And number two, I thought that the cash is going to disappear, and I just didn't know if it's going to be around. It was a 7-year contract, and I didn't know if it's going to finish out that contract. And so I wasn't buying the way I should have. But no, I didn't think it was a fraud. But what do you know? But even with all my mistakes, investing has still treated me pretty decent. It's still been largely a positive experience. But how can we learn what to look for and what not to look for? I think it's through good decision making. And there's a book that has really been affected my thinking. It's called Thinking in Bets: Making Smarter Decisions When You Don't Know All the Facts, by Annie Duke. She was a professional poker player. So why should we take advice from a gambler? It's because there's so many things in life that actually are a gamble. You make decisions based on information. We just don't know all the information, right? And we make statements, and something she says a lot in there is, want to bet? And you find out really how serious someone is. The forecast was for 3 inches of snow yesterday at our place. And if I said, hey, we're going to get 3 inches of snow, and somebody says, want to bet? Like, well, I'll bet on an inch, but how sure am I? But that's a way to see just how sure you are of facts. So anyhow, it was really helpful for me to go through that and look at how I'm approaching life, how I'm making decisions, and whether I'm basing them really accurately. So hopefully tonight is going to help you think of some of those things. Whoops, wrong way. There we go. So principle versus predictive-based investing. What we want to do is invest based on principles, not on predictions. We want to focus more on principles than predictions. Principles are things like cash flow. It's real. real assets, things that are tangible, that are still going to be around in 50 years and still be worth something. Systems that reduce labor. It's called efficiency, and that creates profit. That's good. It's principle-based. Predictions, predictive things, what's the interest rate's going to do? Should I buy now? Should I hold off? A lot of that creates confusion. I mean, it's a real cost. It's good to consider, but all the same, it's predictive. Market conditions. Are we going to have a slowdown? What's happening? And you dilly-dally around, and you think you buy because of, how about government ebbs and flows? There's just so many things that create confusion, but if you stay with the principles, you're going to do a lot better than if we come over on the predictive based. So we want to focus more on predictions, on principles rather than predictions. Oh yeah, my wife caught the Amish flu. First she got a little buggy, and then a little hoarse, and finally she got a cold. Anyhow, so another thing to help us figure out what to buy, what we should own, is if we can define our personal investment philosophy. And that word there on the left, personal, that's a big part of this. What I do might look pretty stupid to the rest of you, but if it works for me, then it's good for me. Like, this isn't right and wrong. And I'm going to tell you a little bit of what I do and why I do it. And what you do is probably going to be different from that, and that's perfectly good. It's even great. Those differences are what make America great, and what creates a buyer for every property that comes along. That's Evel Knievel. Does that sound familiar to anyone? You ever hear his name? So he was a daredevil, a stunt rider, and he basically, what I want to tell you about him is a word of caution. It's not always good to be the champion. It's not always good to be the best in class. He has a world record. He had 433 broken bones in his lifetime. So there's probably a certain group of people that really think that it's awesome what he does, and it is cool. I've watched his jumps, and it's cool. But I don't know if I'd want to get 434 broken bones just to beat him. There's a fellow that worked for me that his goal was on his 18th birthday, he wanted to go to a bar and set the record for the most alcohol that was consumed at that bar. And he was practicing for a year leading up to it. I don't know how he got all his booze as an underage guy, but he drank a lot. He could hold a lot of booze, and he was practicing working up alcohol tolerance. And on his 18th birthday, he went to the bar, and he started drinking. He started early, and he kept going, and he was there right there at the record, but he was so drunk he couldn't drink out of a cup anymore, and he couldn't keep his head straight with the straw. And the bartender had to hold his head on the straw, and he sucked it down. He set the record. It's something he's really proud about. Do I admire him for it? No, not at all. I actually think better of him because he went to rehab for alcohol. It really had a grip on him. Anyhow, he went for rehab. So there's probably a certain group of people that really admired him for that. Why am I telling you that? Because sometimes it's good to be mediocre. That's probably not what you expected to hear. But you got to realize sometimes it's really good to be mediocre to those that you don't care about. But be a champion in what matters to you. You decide what's important in life, and you make sure that you're doing really good at that. So for your personal investment philosophy, you want to have clarity before you spend capital. There's a fellow I just spent some time with, and he's getting older. He's looking at retirement, and he was looking for ways to reduce his taxes. And I suggested to him that he could buy equipment. In 5 years or so, he's going to be selling his businesses. He could buy equipment and stockpile it and then sell it. He'd want to have equipment that doesn't depreciate, but he could use that as a deduction, and then sell that equipment after he closes down his businesses, and bring that money back in slowly, maybe 200,000 a year or something like that, and he wouldn't get taxed too badly on it. And he said, "Nah, I don't want to do that." Had no interest. He had clarity. He didn't want to do that. And I said, "Well, okay. Well, you could buy a chicken farm. It's that there's a lot of equipment on a chicken farm, and you could rent it out, and then you could sell the farm. You could finance it, and then the money would come in slowly." And he said, I'm not buying a chicken farm either." That's fine, right? He knew what he wanted, and I'm glad that he did, because if he would have wanted to do things my way without him wanting to do it, he would have muddled around, been miserable, and it would have been my fault. So he had clarity. He knew what he does not want to do, and that made it a lot easier. Unless your goal is big enough to scare you, it's not big enough. You ever hear things like that? It's inspirational. It makes you think. I'm going to say a lot of times, I don't know. I used to like that better, but we're talking about personal investment philosophy. Some people call that the undisciplined pursuit of more. Maybe it's good for you, and maybe not, but it can create a lot of frantic activity where you're chasing more so quickly that you don't really make sure that each move is a good move, and it can set you back more than it helps you. What do you think Warren Buffett would say about that? Did you ever look at the graph of his wealth? Anyhow, and if you like that, I'm not knocking it. But I'm going to tell you a little bit about my personal investment philosophy and why. And you can think it's the dumbest thing ever, and that is perfectly fine. I'm just telling you it's personal, and I'll tell you why. So for me, I've come to the point where I like quality better than I like quantity. If we, the cool thing to do is supposed to be to expand and grow like crazy, delegate. We're not doing any of the work ourselves. We're just managing, right? I was just at a business here 2 weeks ago I was never at before, and I walked in and I told the guy what I wanted, and he's like, "Oh yeah," and he got his blue Dickies coat. It wasn't any slick Under Armour coat. It was a work coat, and he had work shoes on, and they were polished. It's been years since I saw polished work shoes. It really impressed me. He cared about details, and I felt good about getting work done there. And he took me out, and he showed me where to go, and he got guides to unload and help me out. But I saw him, and he was there to do work, and like we were friends. I really liked what I saw. It's all good to be an important person and be in your office and never to get your hands dirty. That's perfectly fine, right? But I like craftsmanship, and I like that. To me, that fella and the type of work he was doing made me feel better than some really posh place, some exotic location. Might not be for you. I'm telling you what matters to me. So my personal investment philosophy has become storage. And I'll tell you why. I was chasing yield. Remember, I didn't buy a lot of ATMs because I thought they were too boring, right? I thought I could make more money other places. And I did make some money other places. I also lost some money other places. But something that I came to realize is that with when there's yield, when you buy a property, there's two parts. You have the asset, right? If you want to have income from it, it's going to require business. And my business is trucking. I can try to have an Airbnb business. I can try to have a long-term rental business. I can try to have all these other businesses, but there's something that I've learned, that a man who chases two rabbits catches neither. So if I'm going to have more businesses, that's perfectly fine, but I'm going to have someone to run those businesses. I can't do that and do a good job. So what I was doing in chasing high yield is I would earn income, and then I would put it in something, buy an asset that I thought was going to create a huge return, and I would lose it. Because I was chasing yield, it was a poorly managed business. Does that make sense? So if I can have a well-run business and I store that money, I'll be in good shape when I'm 70 years old. But if I keep chasing all these rabbits, I'm not going to be in good shape. So like Jake had said, my outlook is really different than his. His business is managing real estate. And so he can have an active business. His real estate can produce income, and that's wonderful. I have some Airbnbs, but I don't manage them, right? Jake does. He has an advantage over me because he's really involved and he can take, but I can't. So when I'm looking at something, I'm looking for storage anymore. Income only comes from business. I already told you that. So, and I told you this too. When you buy a property, you have the asset, and then if you want income, you have a business. So, looking at that property, what kind of business do you think you could run out of there? Vacation rental. That's exactly right. So, it would be ideal for that. You would not want retail. You would not want commercial, but for a vacation rental, perfect. More business, more income. More effort, more complexity. If you work hard, you work fast, you make lots of money. And if you systematize it all, you can hand it off and you can do well. But if you want to generate income, you need to have a business. So look at those two properties. The one on the left, let's say that's 500 acres of forest, and the one on the right, let's say that's 5 acres with 1,000 apartment units on it. I'm sure it's not that much in that picture, but just for the sake of the conversation, let's say it is. And let's say the guy on the left is a guy like me, but even worse, and he doesn't even manage to timber. So there's nothing going on. There's no income. He still has to pay taxes every year, which means that he's going to have a business somewhere else earning that income to pay those taxes, right? On the right, the guy there, he's extremely involved. So he Airbnbs every last one of those apartment units. And so he has 1,000 guests checking in every night. He's going to be extremely busy, right? But he'll also have an exceptionally good return as long as he can rent everyone out. But when you look at a property, you need to decide, are you looking for storage? Are you looking for income? And if you're looking for income, how much business are you willing to engage in to create that income? So my business creates cash, and my investments store that cash. Now, when we look at the skeletons of investing, I'm not talking about scarecrows, we're just past Halloween, or skeletons from dead people. I'm talking about the bones, the timbers, the strength. What's the strength of your investing? So when you look at what investing is, it's basically purchasing assets with the expectation of storage plus increase. And that increase, there we go. The increase is from business. What else could it be? It could be inflation, and could be from more utility. By the way, on inflation, that doesn't, it's not actually making you richer, it just feels richer, right? Let's say that you buy, land, and the price per acre was 4 cows an acre, and when you sell it, it's 4 cows an acre. So if you were paying interest all those years and you only got 4 cows, you lost money, right? It's a real expense. But since money is a melting ice cube in your hand, that really changes things. And I kind of held my breath this spring. I have debt, and I'm depending on inflation to make that debt easier to pay. And when Trump and Musk teamed up with Doge, I was like, what if they actually cut deficit spending? Then what's going to happen? Will inflation actually go away? I didn't know, but that's different. And I really held my breath, but they gave up on it now. And there are certain things I like about Trump, but when he signed the big beautiful bill, there was another 2 point some trillion of deficit spending. It was as much as ever, and they completely closed down Doge now. So my opinion is that Trump, he doesn't care what people think, right? Elon Musk doesn't care what people think. If they couldn't get rid of the waste in government, I don't think anyone will. I think it's baked in the cake. And I'm expecting there's going to be more inflation than ever. So if you only want storage and you're not even worried about inflation, you can just put your money in a bank, and you can put it in an Amish bank of some sort, where you don't have to worry about bail-ins or anything like that. But if you're worried about inflation, you want to have an asset that is indexed to that. And when you buy, let's say you buy a farm in Lancaster County or in some area where there's Mennonites, basically you're betting on the reproductive rate of the community, right? Because every Dutchman wants a farm. As long as there's more young Dutchies than old Dutchies, the price is going up. So, more utility. If for example, there was a house that I bought in Lewisburg, a town close to us. It was just a rental house, and I bought it because it was a good price. And what do you know? As the years went by, there's a new town center went in right across the road, and all of a sudden it's a more desirable neighborhood. And there's a rails to trails went in on the south side of my house there, and all of a sudden the house is worth more than it had been. It's still the same house, and it's still kind of dumpy, but it's more desirable because there's more utility there. And there's what was that? Oh yeah, story time, but not quite yet. So there's urban sprawl that comes along. If you buy a place on the edge of town and the town grows out, your property becomes worth more because of that. But something that's that we have to realize is that when we're talking about appreciation, we only make money from happy surprises. Because see, once everyone knows about it, the price goes up, right? So it's a happy surprises. When you buy a stock and the stock goes up, there is some happy surprise happened. If everyone expects it to go up, then like Tesla, for example. I know I like Musk and he has a good company, but it's valued extremely high, and it's because people have those expectations. So those happy surprises only happen if you're in the market. So Washingtonville is a town about 10, 15 miles away from our place, and there's a data center going in there. Why do you care about that? I just want to tell you, because of these happy surprises. Farmland last year was selling for somewhere between $6,000 and $10,000 an acre there, and it was really up. Like 5 years ago, it was selling for $3,000 to $6,000 an acre, and it's not what it's selling for this year. The data center is offering farmers $100,000 an acre, and they're kind of pushy about it. They want it. But see, if you go to try to buy a farm there now, you're going to pay more than $6,000 an acre, right? because it's not a happy surprise anymore. And you only get that by being in the market. You have to buy, you have to be in, and then those happy surprises come along. And the people that are expecting, like if I buy something and I'm expecting some, a 10x multiple in 5 years' time, I'll get discouraged. I'll sell. I'll get out of the market again. I'm never going to realize it. And there's costs to buying and selling, so I'll probably lose money. So we need to be in the market. We need to be patient, think long term. But it's when we're in the market long term that we get these happy surprises. Risk management. Successful investing is not about it's about managing risk, not avoiding it. Benjamin Graham. Does that name mean anything to anyone? Who's Benjamin Graham? That's right. So if you think Buffett knows a lot, you should really perk up when you hear Benjamin Graham, because he taught Buffett the principles that made Buffett who he is. Oh, I like that. It's a billboard. This year, thousands of men will die from stubbornness. No, we won't. Managing risk is very different from managing strategy. Risk management focuses on the negative threats and failures rather than opportunities and successes. So that's kind of a negative slant, right? A good sales pitch tells you about all the good stuff, all the rosy stuff that can happen. Risk management is the opposite. That's looking at the negative. What happens if? Do I have a contingency plan? But it's an important part. So we don't want to be doom and gloomers, but we have to be realistic. Risk management. Something that's an important part of risk management is cash flow. That's something that sticks in my mind extra much now. Like, I always knew cash flow is important, right? But here a couple years ago, me and some others bought some some timberland, and we were expecting carbon credits to come in a big way. And we had the contracts, and then there was fraud in the market. The contracts went away. There's very little cash flow on timberland, and it stinks paying for it. Like, I'm tired of it. But I signed it, so I have to be a big boy and make the payments. But if you have cash flow, you can't go broke. The more you buy, the more money you make. Grant Cardone said that he has never purchased anything that didn't cash flow. He's doing pretty good, and I would say that's a good tip. Now, back to what I'd said prior, there's going to have to be a business involved there. But if you're going to take on debt, you either need cash flow or you need another business to pay for that debt. Competence. Another part of risk management. How good are you at what you're doing? How well do you know what you're planning to do? Property selection. Depends what you're planning on doing with it. Let's say you're planning on doing a vacation Airbnb. In that case, you probably want a hilltop. You want a waterfront. If you're in town, you're Airbnb in town, the location's probably important if you're in the business sector, where people can walk from the high rises to your Airbnb. If you're doing commercial, you'll care about traffic count, about the streets that you're on. So property selection is a big part of risk management. Leverage. So understanding how leverage amplifies both risk and reward. There's fixed rates, there's variable rates, there's you can do creative financing, you can do owner financing. There's a lot of things you can do with leverage, but it amplifies both risk and reward. That's great when it's going good. When it's not, it stinks. But for example, that would be a 10-to-1 ratio, but a $1,000 deposit gives you $10,000 of buying power, which means that if your $10,000 asset over here that you bought goes up 10%, you made 100% return. That's fantastic, and you look really smart. Now, if it goes down 10%, you lost 100% of your money. If it goes down 50%, you're going to have to pay out. Fixed rates versus variable rates, when to finance. That's something that you have to, depending on the situation, but it's part of it's an important part of leverage. Guiding principle: use debt wisely. It's a tool. It's not a trap. If it's used foolishly, it becomes a trap. Source of funds. What was I planning to say about that? Oh, yeah. But I already told you that. If your property doesn't produce income, then you better have a business that produces income. So there always needs to be a business somewhere involved. So if you have debt, you're either going to have a business on the property, or you're going to have to have a business outside the property to pay for it. Crypto-based leverage. So when you're talking about leverage on a property, it's wonderful. Crypto-based leverage is even more so. Crypto is volatile. With crypto, it's either liquidation or Lambos. There's no in between. It's just everything amplified, right? Now, if you're a Dutchie and you don't believe in bankruptcy, you have to be more cautious than people that are okay with bankruptcy, right? You read the books and you see all the leverage plays, but you have to think about what happens if things go sideways. Because if there's a committee comes in and you don't have power over your checkbook anymore, and you have to answer for every dollar you spend, and they tell you what to buy and what to sell, it's not fun. So it's something you have to consider. There was a quote. I thought it was before this. I guess we'll come across it. But it's something in regards to, if you have to be careful that you don't ever put yourself in a situation that you can't recover from. What's the cost of your failure? It's to never, here we go. The key to risk management is never putting yourself in a position where you cannot live to fight another day. Bullets versus cannonballs. You ever hear that term? What does that mean? Why would you do that? That's right. So Jake says first fire some bullets and then fire cannonballs. The reason is because bullets are small. You can shoot a lot of bullets. You can miss with bullets and it's all right. But you only get so many cannonballs in your life. And so start small. Make sure that you can do it. Make sure it works. And when you start hitting your target and you know there's something there, fire a cannonball. But it's a big part of leverage. Use bullets, not cannonballs, unless you're really sure. Contingency plans. What happens if something goes wrong? What kind of exit plans do you have? There's a wealthy fellow that told me you should never be leveraged more than 50% of your net worth. And again, if you're a young guy and you have $100 and you borrow $100, you're leveraged 100%, no big deal. But this guy had a substantial amount of money, and if you go upside down, the bigger you are, the more problems it makes and the harder it is to recover. So that was his perspective, and he always wanted 7 months of reserves. So he wanted, if his income totally stopped, he wanted enough money that he can make payments for 7 months and he's still in good shape. And that gives him peace of mind. So, there we go. Leverage strategy, 50% debt ratio, and 7 months of reserves. So the key to risk management is to never put yourself in a position where you cannot live to fight another day. Does that make sense? It's awesome winning, and those stories are wonderful. But for, like the story about the movie Rocky, is anyone familiar with that? Kinda? Not really? All right. So Sylvester Stallone, I believe he was homeless. And he came up with this movie plot that he really wanted to. It was a good movie plot, and that there was he had people that were willing to produce it, but he wanted to be the actor, and they said no, he can't be the actor, and maybe he became homeless, but he was willing to not have income because he wanted to be the actor so badly. And eventually it turns out they did allow him to act, and he did well, and he became a movie star, and it was an awesome story, right? But for every story of a big win like that, there's 50 stories that you just don't hear about because it doesn't make headlines. It's people who thought they could, and they got so close, and then they fell short. So dreaming big is awesome. Like, it's really good, and I think we should be everything that we can be, but let's not put ourselves in positions where we can't live to fight another day. Oh, one Sunday morning, a preacher told his congregation, everyone wants to go to heaven, come down to the front. The whole church came forward except for one man. Thinking that maybe the man hadn't heard him, the preacher repeated the invitation again. The man just sat there. Sir, said the preacher, don't you want to go to heaven when you die? The man replied, oh, when I die? I thought you were getting a group together to go right now. Clarity matters, right? All right, paradox. A paradox is a statement that seems self-contradictory or logically unacceptable, yet might possess an underlying truth. Often highlights inconsistencies with accepted beliefs, revealing that our understanding of reality is incomplete or nuanced. For example, a liar paradox. If I tell you that I'm lying, is that true or is it false? Like, if you remove one grain of sand from a heap, you still have a heap. If you keep removing single grains, when is it no longer a heap? So anyhow, it's kind of circular reasoning. However, there are times when we have to hold opposite truths in mind at the same time in order to do well. The Stockdale. Yeah, but I think I misspelled that. That was Stockdale, wasn't it? Yeah, I just wrote wrong at the top. All right. So the Stockdale paradox. Um, in case you don't know, that was a fellow that was captured over in Vietnam, and he was in prisoner of war camp for a long time. The people who survived held two truths at the same time. They never lost faith that they would ultimately prevail. They really thought they're going to win. But when people asked him who died in prison, he said it was the optimists. That's who died. The people who survived never lost faith they would ultimately prevail. They also confronted the brutal facts of their current reality with absolute honesty. Opposite truths, right? That's the Stockdale paradox. So, being brutally honest and optimistic at the same time is how you build staying power. And that's what wins the game. If you look at Buffett, he did good over the years, but here, check that out. I think he hit $1 million at age 30 or soon after, and we see he hit 10 mil. It would have been short of 40. That's a lot of money. And 1.4 billion, age 56. Yeah, it's a lot of money. Age 66, 16 billion. That's tremendous. But look at what happened towards the end. And all that money that he made earlier looked so tiny. If he would have retired at age 65, you probably would have never really heard about him all that much. He has been a phenomenal investor, but he goes for solid wins. The whole tech bubble came by. 2001, when that tech bubble crashed, he didn't lose money, or he lost very little, because he didn't buy tech. He said he knows nothing about it. The entire crypto, all the money that was made and lost in crypto, not him. He said he doesn't know anything about it. He's not buying into it. And yet he's done better than me, and probably better than you. So going for solid wins, there's something to be said about that. Does anyone know what his 3 rules of investing are? What's that? Yeah. What's rule number 2? Oh yeah, it's a good idea. Joe said, never lose your principal. What's rule number 2? Yeah. Yeah, that's right. What's number 3? That's right. So he was. How's that? You're right. With real estate, location, 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 and that is like Buffett buying good stocks, right? We need to buy good properties. So anyhow, he wants good value, and he really looks for good value, but I think he's looking more for value that will keep growing steady and calm rather than some wild win. And I think that see, you see all these big quotes, like the one about unless your goal is big enough to scare you, it's not big enough. You see those, and it's cool. But I'm getting to be an old man, right? And I'm telling you, a lot of times those guys don't make it, or they go for a little and then they fizzle out, and I don't know. It's they. I think that huge goal creates a frantic rush towards action rather than quality. I don't know. If you want to have tremendous goals and you want to reach for the sky, I applaud you. I sincerely do. And I hope it goes well for you. It's just, for me, it works better to be steady than it does to try to grow like crazy. Real wealth and real estate comes from time in the market, not from timing the market. One of my friends in Florida, this would have been, this was pre-COVID. He bought a couple acres, and it would have been about 2012, and he didn't pay much for it. Florida real estate was in the dumps, and about 2018, he said, this is a market top. He's selling, and he's just renting until it crashes. He's going to buy again. He missed it. He was trying to time the market. Like, he bought at an awesome time. I think he paid, don't hold me to the numbers, but I'm thinking he paid $50,000 for his little ranch that he bought, and he got $600,000, which is a tremendous increase, in a couple years' time. But now it's double that. He was trying to time the market, and if you have a solid, go ahead, take it. But there's a fellow that I follow. I can't think of his name right now, but he said everything he has is for sale. The only requirement he has is that he needs to find something that's a 50% better deal before he'll sell. So he'll sell anything, but he doesn't just want to hold the cash. He wants to identify something else that's a 50% better deal. In commodities, you really see that, right? So I had some ag examples. I have a little farm, but for example, cows right now are crazy high. And in 3 years, they're going to be crazy low. It's just how it always works. So if somebody wanted to buy all my cows, I'd probably sell them. I'd need something for the boys to do. They'd probably figure something out, but I think it's good for them to work. One of my boys is here, so he'll anyhow. But for example, cattle are really high. They're at all-time highs, which means there's maybe that much of a chance that they'll go even higher, right? Let's say the price is here. Normally the price is here. Maybe it'll go a little bit higher, but there's this much chance that it'll go down. But now look at something like OSB. I'm not sure what it is right now, but just 2 months ago, I think it was at $8, and cost of production had been at like $7.50. It's not going to go much lower, right? If it goes much lower, they're shut mills down, and then the price is going to go up. So if I'm going to sell cows, I should buy OSB. and then I could store it in the barn where the cows are until the price goes up, and then I can buy cows again. But anyhow, that's how we should look at if we're going to time the market. Don't just get out and stay out. Buy something else that's actually down right now. Compound appreciation, real wealth and real estate. Compound appreciation, it's tremendous. My grandpa bought my dad's farm in 1946, and he paid $3,500. If he would have put that money in the bank, he would have gotten some interest on it. I don't know what it would be, but I guarantee it'd be less than what the farm's worth now. It's just amazing what compound appreciation does. Some of that was increased utility, right? There's more Dutchmen in that valley, and the farm has been built up. It's doing better, and a lot of it was inflation. But compound appreciation is tremendous. Amortization. When you have a rental house, we forget about this sometimes because it's so slow and so boring. But suppose that you say, hey, Matt, I'd like to buy this house. And I'd say, oh, it's a great idea. And you say, I don't really want to pay for it. I say, oh, that's no problem. I'll pay for it. And you're like, really? Like, yeah, just let me live in it. I'll pay for it. I'll even give you a little extra. That's what happens when you rent out a house. It's a fantastic deal. And we shouldn't forget about it. It's really slow. It's really boring. But somebody says, hey, man, do you mind if I pay for your house? And so they pay for your house. It's tremendous. After 20 years, you'll be really happy. But it comes from time in the market, from longevity. Rent growth over decades. That's also inflation index. But when you buy a house, like that house in Lewisburg that I told you about, it's probably been 15 years since I bought it, and it was on the market for about $100,000. I knew the realtor, and he like really bugged me. Would you come look at it? And I'm like, well, I guess. And he said, well, he knows that the guy would sell it for $45,000. I was like, oh, all right. Well, when are you free? He said, I'm free right now. I said, well, I'll see you there in half an hour. And I bought it, and I didn't talk to my wife about it, and she was fine. But you know, the rent in the meantime has gone up tremendously. It wasn't me being smart. It was just me doing my thing. And 15 years later, I look really smart. But it was good value, and I stayed in the market. And that's going to happen for you too. Just make sure that there's value there and that there's cash flow, so you don't have to work too hard in your other business to make those payments. So, the guiding principle: patience builds profit. Legacy, stewardship, and giving. So when we make all this money, what are we going to do with it? It can kind of be a tough thing because there's part of the struggle is part of what makes people healthy. 8 o'clock. How long am I supposed to talk, Jake? 30 minutes. All right. I'll try not to be too long-winded. Part of what makes people healthy people is a struggle. And if I make it too easy for my kids, are they going to struggle enough to develop? I don't know. When there's a butterfly coming out of the cocoon or out of the little hard shell, forget the name for it, but if you cut that open and you just let the butterfly out, it never develops its wings. That struggle is important for it to live. So anyhow, I don't know how much money I should leave to my kids. There's benefit, but that's something I haven't discovered. So if you have words of wisdom, I'm all ears. So wealth is a tool for impact, not just comfort. It's nice to have nice stuff. Like I really like when I go to start my lawnmower and it runs. It's really nice. It's so much fun having good stuff. But it's also a tool for impacting other people, not just comfort. Who do we give money to? We don't usually give money to rich people. We usually give money to poor people, right? Now, there's two types of poverty. Does anyone have any idea? What would be two different types of poverty? Yeah. Man, that's a fantastic guess. You're right. But see, I see it as situational, where maybe my barn burned down, all of a sudden I'm poor. Or my cows were out in pasture and lightning hit them and it killed all the cows. It's situational, right? I was doing a good job of farming. I was doing everything that I was supposed to do, and some situation came along, and I suffered a loss. The second is systemic. I don't get up in the morning when I'm supposed to, and when I go to work, I don't work very hard. And when it's springtime and I'm supposed to be planting crops, it's good time to go fishing too. That's systemic. That's an issue. So situational, it's a lot easier to give in situational situations. Systemic, we have to be careful that we don't create a welfare system where people are rewarded for being sloppy. And my grandpa, when they butchered a cow one time, and there was a poor family in the neighborhood there, and he said, "Hey, you want a front quarter?" And the dad said, "Well, we'd really want a hind quarter." And sometimes people do that, and you have to be okay with saying that, "Sorry, you can get a hind quarter if you want to pay for it. I'm offering you a front quarter. If you don't want it, no problemo." But anyhow, you don't have to make it too easy for them, right? Sometimes a little pain really does a lot. If you make it too easy, you're actually hurting them. So there's yeah, there we go. This is one of those paradoxes. Rabbi Lapin talks about, it was Deuteronomy maybe. God was telling the Jewish people that if you do this, 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 and this, you're going to prosper. And then it was followed like 3 verses later by, the poor you will always have with you, and you were supposed to give. So basically, we have to, it doesn't feel fair, right? We're given the instructions on how to prosper. If we do that, we're going to prosper. You get up early, you work hard. Solomon said, "Go to the ant, thou sluggard," right? If you do that, you'll probably do okay. You might even do fantastic. Followed closely by, the poor you always have with you, and you're supposed to give to them. So there's a requirement, and part of that is we don't just give for their benefit. We give for our own benefit. It's good for me to give. It reminds me that it's not all about me. So anyhow, that's something we have to be okay with, and we have to think through, and it's part of being a big boy, right? We have to decide those things. So how about situational wealth and systemic wealth? You have any idea what would be an example of situational wealth? Lottery, absolutely. And how about systemic wealth? How would you describe that? You had to work. That's right. It's a well-managed business. You put in effort, and it generates income, right? So, yeah, okay. Here I was going to tell you that wealth and poverty are actually kind of related when you think about it. Situational wealth is a lot like situational poverty. It's just part-time. You win the lottery, it doesn't last long. Boom, it's gone. You're worse off for it. Situational poverty, where something bad happens, you work your way through it, and you're better off because it happened, right? You learned lessons, and you became stronger through it. Systemic wealth has staying power. Systemic poverty has staying power. It's kind of remarkable how it works. But when we understand that, it helps me to know where I want to be and understand what I want to be looking for. And I'm just going to tell you that winning a lottery, like some of these big crypto wins, there's a lot of flashy cars and stuff in the crypto world, just because it's kind of lottery. It's such a fantastic amount of money. You haven't grown your way into it. You don't know how to handle it, and it doesn't stay around long. So anyhow, my My goal is to have systemic wealth for situational needs. Giving. Just for the sheer joy of giving. Look at her. So this is a little bone I wanted to pick with. There's a difference between giving and giving back. If I'm giving, I'm giving because I want to give, I should give. If I'm giving back, that means that I took, right? If I need to give back, then to me that means there's something else going on. That means I took. I need to stop taking and I need to give back what I took. But if I exchanged value, if somebody's life became better for giving me money, they were better for the transaction. And then I can share, I can give out of that. But if I have to give back, anyhow, it might be a little bit of wordplay, but when people talk about giving back, it always bothers me. To me, that means that I took, and I don't want to take. So, making quality bets. I was going to talk more about that book, but if we make decisions that are gonna that will turn out well and that we're going to be happy with, I have a little list of things here that I think are going to help with that. So I numbered them, and the numbers aren't necessarily in order of importance, but just things that I think are worthwhile, for me, are very worthwhile. Number 12, personal investment philosophy. If I know what I want, why I want it, how I want to do it, it helps me know what to buy. Low trust and a high trust culture. Oh, I didn't tell you about that. So with a lot of these contracts, especially in syndications, I signed the ATM syndication contract, right? And in that contract, I read it afterwards. And it said that even for fraud, I'm not going to press charges. Remarkable. But I signed it. I can defend myself and say I had high trust. I'm a Dutchie and I trust other people, and yeah, they'll do what they say. Fine. But that contract showed low trust, right? In a high trust culture. Now, I think we should have contracts when we do business with each other, but it should be equally fair. And when I sign a contract, if there's something in there that I don't agree with, I shouldn't sign it, because it was probably written that way for a reason. So anyhow, more recently, there's a couple real estate guys that borrowed money, and old order Amish, but they borrowed money from people, and the funds are extremely upside down. There's people losing money, and it pains me to see that. But when there's contracts that show low trust, and it's in this high trust culture, I think that's a warning sign. So anyhow, making quality bets. When you see low trust in a high trust culture, it's a warning sign. Principle versus predictive based investing. If you invest based on principles, I think you'll do well. Tithing, that's a really quality bet. If part of your goal is storage, and God says, when I give you $1, I want you to give 10 cents back, and as long as you keep doing that, we'll keep the little deal going. That's one person you probably shouldn't rip off. Assets plus business. When you remember that if you want income from your properties, you're going to need a business in it. It helps you decide what properties to buy, because you might be good at one type of property business, but maybe not another, and that might keep you in one segment. Or if you branch out, just know what you're getting into. So just remember, when you're buying a property, it's asset plus a business. When you make a quality bet, you can look at your skill set and your work ethic, and that's going to make a big difference on whether you'll do well or not. Look at that. There's a whole list. All right. So in rental properties, Airbnbs, the population wanting easy choices. I like easy choices too, but if that is, you can make quality bets when you if you can cater to those people. If you buy in areas with population growth, I was just talking to a couple of fellas before. I have land in West Virginia, and something that's remarkable is that the population of West Virginia is the last time that it was this level was 1946. It's a really different dynamic when houses are going vacant and they're falling apart because there's no one to live in them. So around here, you can buy any house you want, rehab it, and you can do well. So if you want to do well with real estate, try to buy in an area where there's population growth. Urban sprawl, that makes you look smart after 20 years. Amortization, when your loans get paid down, someone else paid for them. It's tremendous. Inflation, it's that is a huge deal, and I'm telling you, I cannot see any other way out of it than more inflation. If you could rewind the clock, everybody talks about 20 years ago we could buy this for this. Guess what? 20 years from now, you're going to be looking back at today saying that. So make sure you buy something. And the only one completely foolproof thing is Jesus Christ. Like, I've been disappointed. I'm telling you, I'm not. My goal is not to be up here moaning and complaining about life, right? But the last 5 years, there's been a tremendous amount of disappointments for me. And it's been just about everybody that had trust in, I mean, including church leaders. And it has been good for me because it's too easy for me to put confidence in what I shouldn't put confidence in, right? There is one thing, there's one person that won't disappoint you. It's Jesus Christ. And it's really important to be aware of that. All this other stuff is kind of fluff compared to that, and I'm not here to preach a message. It's just, when we look at what we can do, making good bets, that's a really good bet. All right, questions? Yes, sir.
You mentioned about interest rates and I think government deficit spending was part of your equation there in your thought process. What is your expectation, Lester, about rates and
I'm sure there's people here that are more. There's probably bankers here that know. However, something that was happening. I was talking to a banker last week, and he said that residential mortgages were ticking up a little bit, even though there was some recent rate cuts. So that doesn't always transfers. I'm not sure how that's going to be in the future. However, on Saturday, someone told me that the Fed chair was going to resign on Monday. I didn't hear if he did or not, but today I think I saw some clippings about new Fed chairs. So apparently there's a change of seats in that position, which is probably going to mean if Trump's putting someone in, then there's going to be lower interest rates because he's really pushing for that. And he likes that because of business. He's a businessman, and also because it's going to speed up the economy. And thirdly, there's an awful lot of federal debt rolling over. And I mean, do you think they can just keep paying interest? I mean, interest now exceeds war spending, the defense budget. Is that sustainable? I know. I see. I see that, and I see. I don't see how that can work. But I feel like an old man because I remember when I was a kid, and we were at 700 million or 700 billion of government debt, and there's these guys came around and said when it hits 1 trillion, it's over, and we're adding 2 trillion a year. So I don't know. Yes, sir. All right. So again, listen, if I knew all the answers to this, I could make a lot of money. But so I don't. I'm guessing. But I'll tell you a hint is: have you seen gold price recently? Yeah. Is it low or is it high? I mean, yeah, I think it's completely at an all-time high. I don't think it's ever been anywhere close. Do you know who the buyers are? Who's buying all that? Is it grandma down Main Street, or who is it? That's exactly right. Yeah. There's countries that are diversifying out of US debt. See, when Russia invaded the Ukraine and the US said their 600 billion of government debt that they had is canceled. It's not any good anymore. There's a lot of countries that said, "No kidding, you can do that. I don't like that." And they started selling their treasuries. So what happens if there's no one to buy the debt? Can they just roll it over? I don't know the answer to that. Well, yeah, maybe. Yes, sir.
That's getting in left field. Like, what should we about next year with regards to rates? Like, feel pretty sure they would go lower, 0.5%, 1% maybe, something like that. Or you see them kind of just stand where they
All right. Yeah. That's systemic for the country. Um, so I would say they will go lower. They must go lower. The only way that I could see that they don't is if, see, we've seen this in other countries when there's no buyers for debt, and the rate is not announced. The interest level is not announced, but it happens in the government or the debt auctions, where it goes up, and it's happened a couple times in U.S. debt over the last year, where it really spiked. The interest rate spiked, and they had to do that to attract buyers. So if that would happen, maybe interest rates would go up. But I would certainly think that they'll drop. But there again, if a property makes sense to buy and there's margin there, I think I would still buy it. By the way, this somewhere in there was I was planning to tell you, there's an old fella that's mentored me, and he was born in the late 40s, and he says, "Man, you guys have it so easy now. There's no inflation." And like his when he was really getting established, it was in the 80s. The Russians were coming, interest rates were way high, inflation was even higher. He thinks it's so calm and peaceful right now. We're a bunch of pansies to complain. So yeah, is that an okay answer? All right. Any other questions? Yes, sir. Where the 2 trillion in spending is going? Um, there's, I mean, it's already happening, right? It happened other years too, but there's this one guy that I subscribe to his emails just because it's interesting. But he's pretty negative, and he's always complaining. He never praises anyone. He's always complaining. So I try not to spend too much time there. But he talks about how, for example, Somalians in Minnesota. That was just an email this week. How they've really learned how to game the system, and it was the amount of money that they can get through welfare, and that money leaves, and there's hundreds of millions that leaves through immigrants in Minnesota, and it goes to fund our enemies overseas that we go to fight then. And there's unbelievable waste in government. Um, So I can't tell you that it goes to this department, but I do know that from some freight that we haul is military, and it's those military bases are not run by Amish. I'll just tell you that much. Yes, sir. Yeah. Um, so those were like slush funds where there's people, grandpas that borrowed money to young guys that were investing in real estate. And when a bank borrows money to you, do they trust you? I'm just, do you think they do or they don't? They do. All right. If they didn't trust you, they wouldn't lend the money, right? In spite of the fact that they trust you, they ask for collateral just in case something goes wrong. So when there's hard money lenders, Jeff, you do hard money lending. Do you ask for collateral when you do a loan? Always, right? And you should, right? It's and you don't ask for that because you don't trust someone. You ask for that because it's prudent and it's your job to protect your capital. And there's an agreement with them, and it's not because that you don't trust them. It's because our memories fail, and documents keep friends friends. So the hard money lending that I was referring to was people that were just borrowing money to people, and it turns into this big slush fund. It's kind of situational wealth, right? It's kind of like winning the lottery. The hundreds of thousands to millions just show up, and you go buy properties, and you get sloppy, and that's what a lot happened there. Nobody asked for collateral, um, and the money isn't there now. So it would be a lot more cumbersome to ask for collateral on a property when some young fella asks to borrow money rather than just writing him a check for 500,000. But it would be better, and it would keep things from going sideways. Yes, sir. Yeah. So if I want storage, um, should I just buy gold? Um, that might be okay. I don't just buy gold because I have to keep it somewhere, and if I keep it in a bank, I have to pay for it. It's different than money. Remember, when there's a yield, there's risk. That's like that yield comes from risk. If I'm getting rid of risk and the bank is holding it in the vault, I pay. The bank is holding that risk, so I'm paying for that risk. So, um, and like I would say this is one of those paradoxes, right? Where I'm really happy when a property goes up in value, and I'm really happy when I get good rent. But my primary thing is I'm just tired of losing money. And I want to buy things that do well. Things that I would see doing well. If there's anything I'd like to get into, it would be self storage, because of there's not a lot of residential claims on it. But there's plenty of people here that are doing really good with residential. So if you have a handle on that, it's fantastic. Um, One of my friends buys gas and oil leases, and he has done really well with it. I've never bought one because I don't really understand it. Um, it's a diminishing asset. You really have to know what you're doing. Um, Something that I like is farmland and timberland, but I don't like it with debt because it doesn't produce enough income to pay for it. So that's a real storage area there. If you rent a field to a farmer or you have some farmer on your land, there's not much you have to do with it. Um, but again, it's I don't want any of you to misunderstand me and think that I'm disappointed when I get a good rent check. I'm I'm ecstatic, but and you know, some of the Airbnbs we have are doing really well, and I like that. Um, but for example, there's a house that's right next to us there, and we Airbnb that. We used to long-term rental it, and now we Airbnb it. And the reason is when we get guests that don't all fit in our house, we can just block the Airbnb for the weekend, and it's set up. There's beds in it. And there's nice beds, and there's nice sheets, and there's nice towels because it has to be good enough for 5-star reviews. And they can stay there, and they have a great experience. It's really nice. There's a pool. It's kept after. It's kept after better than if we just kept it for ourselves. So it's just wonderful. So there's a business involved, but there's also a personal aspect that makes it really worthwhile. Um, but that's a personal. I don't feel like I'm answering your question very well. But okay, all right. So my attorney in the late '80s, he had a house in Sunbury, Pennsylvania. It was a nice house in town, and he sold it for 120,000, and he bought a farm about 2 miles out of town, and he paid about 140,000 for it. The house, he just told me that this house sold again about 2 years ago, and it brought about 140. It brought a little bit more than it did back then, but his farm was worth about 1.2. Um, so there, not all assets go up equally. What's rare and desirable, right? I think riverfront, waterfront is rare and desirable. And if you have a waterfront something, I think it'd be good to have a structure on it because you can get grandfathered in. The flood laws are becoming more and more controlling. You can't always build where you want to. So if you don't have a lot of elevation right up off the riverbank, you should probably have a structure there. But to me, riverfront is inland beach. If you have a spot on a mountain that's really nice, it has a view. So for me, I like anything that's kind of rare and kind of desirable, and not too much hassle. Yes, sir. Really? So could you do some workarounds like um, sell it to me and I sell it back to him? All right. Yeah, good point. There's always these caveats, and they can get you. But um, if you have lake view or water, it's a beautiful thing, and I think it's an advantage. 8:30. Okay. Well, listen, I appreciate you guys listening, acting like you're interested. It was good for me to get ready, and Jake, nice to see you again. Thanks for your attention.
Thanks, Matt. That was fun. I don't know if all of you kind of caught what he was saying. There's a lot of things we could review from what he talked about, but I just want to point out one thing, and that is the idea of having a business versus investing. I would have never looked at this way when I started buying rental properties. But Matt and I even had some fun phone conversations around this just leading up to this meeting. And it really has become clear to me that any type of income is going to come from some sort of a business. I think I'm saying that correctly. Um, that is really, really visible when you're talking about an Airbnb. For those of you that have short-term rentals and long-term rentals, you know what I'm talking about. They're a lot more work. Short-term rentals are a business. It's a business stacked on top of a real estate, of an asset. It's two different things. It's connected and it goes well together, but it's two different things. And even a long-term rental takes management. It takes a lot less than a short-term rental, but it takes management. And maybe you say, well, I don't manage my own. I just have a third-party manager. That's fine. That means somebody else's business is operating that. So it's just an interesting way of thinking about it. Then of course the appreciation of the asset and all of that, selling it in 5 years because it doubled because it was COVID, that's a whole different, that's the investing aspect of it, which is not entirely predictable. But anyway, that was good stuff. Thanks, Matt. Thanks for coming all the way down here and entertaining us for an hour and a half. Just a couple of quick notes to wrap it up. If you do not have, I don't know how many of you, well, I did ask for a show of hands, but for those of you that are interested in listening to Matt's weekly Monday morning calls, I'm going to give you that number. I'll also put it on the email that I send out tomorrow, but if you want to jot it down right now, I will give it to you. So that phone number is area code 757-841-1184. 757-841-1184. And you'll need an access code that is 626762 and the pound sign. 626762 pound. Like I said, I often listen to it on my Monday run, usually 30, 40 minutes, something like that. Usually some fun stuff. One final announcement, and this is a pretty important one. No meeting in January. Shady Maple did not have our regular meeting space available. And rather than trying to figure something else out, we decided taking a January off right after the holidays wouldn't be a bad idea. So no meeting in January, unless you want to come with a group of your friends and grab some food and sit down and have your own meeting. That's actually kind of a good idea. But no meeting, no Lancaster meeting in January. We will plan to be back here the first Wednesday evening in February. So hope to see you all then. Thanks for coming out.